If you are able to qualify right now and buy your home, and yes, the mortgage payment will be a little bit higher than what you want it to be, but it's still affordable to you, then why not lock in a home now? And then when rates come back, you're in a position where you can just refinance. You don't have to compete against the rest of the market.
The number one mistake first-time buyers do when it comes to house shopping or dealing with a lender?
Well, one of the mistakes that I think they don't know is, how much their credit impact their rate and how much their spending can limit how much home they can purchase. Some people go out and buy that fancy car first when that takes away from the income that can help them qualify for the more comfortable home that they really want.
Welcome to Market Update with Noel Sesay. Today I'm excited to bring to you one of my favorite lenders, Romy Espino. We're going to be talking about the current mortgage and housing market and everything in between. Romy has been in the business for quite a while, and we're excited to have her here and talk about her expertise and what she sees going on.
Thanks, Noel. Thanks for having me. It's a pleasure to be here, and of course, it's always great working with you. So I'm glad to share whatever information we can with our buyers, our prospective sellers, and just share with them what the market is doing, because at the end of the day, it's really all about educating our people, because real estate is all about where you live. You can hear different things out there in the news, but that's not specific to what your current market is relatively. Can you agree?
Absolutely. So tell us how long you've been in the business.
Oh, I've been in the business for over 20 years now. I work with Prosperity Home Mortgage. I am located in Fairfax, Mosaic. That's where my office is, but I am licensed in Virginia, Maryland, D.C., Nebraska, Georgia, Florida, and Texas recently.
I love Florida.
Yeah.
I just got my license in Florida, so
I love Florida.
Maybe we'll do some business.
Yes, we're going to continue doing business in Florida, yes.
That's right.
We're going to be snowbirds.
Right,
it is booming.
I didn't know about Georgia, but the market there, I heard, is booming as well.
Yeah.
And you've been with Prosperity the entire time? Or?
No, not the entire time. I started with other companies in the business. I actually started at a title company as a receptionist. And then later on, I became somebody that helped the processor in the back of the title company. And then after that, I was like, back then it was the HUDs, and it would show you what people would make. And I was like, who is that? And what are they making? And I was like, that's who I need to be. And here I am today as a mortgage consultant.
Well, as we were talking about earlier, you guys had a great run, when the rates were pre-pandemic. Can you tell us how has the business shifted from when you started, I guess, even pre-Dodd-Frank and pre-pandemic, but mainly pre-pandemic to now? Okay.
Well, pre-pandemic, I can say the rates were probably like in the mid-4s, And I remember pre-pandemic, it was still a buyer's market. It wasn't as competitive as things were during COVID, but it was still a buyer's market, but it wasn't as crazy. During pandemic, when the rates went down, it's like the floodgates opened, and everybody wanted to buy, and everybody wanted to refinance, and everybody wanted to take advantage of the low rates. So my phone didn't stop ringing. I was working 16-hour days. It was bad. It was tough, but we were able to help out, quite a lot of people. Unfortunately, some people were getting outbid, you remember, it was 15, 20 people. It was a war. Yes, it was a war zone. It was a bloodbath. People were offering over $100,000 on a listing cash, waiving appraisals, contingencies. There were no contingencies. It was just bad, And now, when the rates have gone up, and now with rates going up, it's definitely slowed down the market, but it hasn't impacted all of the areas. And what I want to say is there are still houses and pockets of sought out, neighborhoods that people are just waiting. Right. They're just waiting for something to show up because that's where they want to live and they know it. So those markets and those homes, when they're priced well and they show well, they are still being sought out, and you are still dealing with competitive offers. Like, you might not be competing against 18, 20 people, but you're still competing against 3 or 5 maybe. You know what I mean?
That's still, I mean, more than one is enough.
Yeah.
Yeah, no, that's what I tell people too. Like, you're not seeing 10, 15, 20 offers. It was insane. And I tell people too that I think expectations have to shift. So a lot of our industry is based on expectations, and a big part of our jobs, I think you'll agree, is managing people's expectations, right? So, you know, you had this crazy market that was going at 150 miles an hour, right? So now it's going at 75 miles an hour. Still fast, but, you know, people are freaking out because they see the difference. I know that when I started, I think we started at the same time. We're talking, I got my license in 03. And I remember, I mean, the rates at that time, that was the first real estate boom. The rates at that time was 6.5%.
Yep.
So I remember my mom calling me, like, you got to buy right now. You know, you got to get serious about buying, because rates are 6.5. Rates at that time had fallen to a 30 or 40 year low. You know, because, you know, our parents were buying at 13%. You know, they were happy when they got 11 or 9%. So I think expectations shifted. So what we're seeing now is kind of another shift. So I tell people, you know, it's not, granted, homes weren't as expensive as they are now, but it wasn't that much off as it was. And also, I feel like we're fortunate enough to be in this market. Like, the inventory is super low. So I think that's another thing that's kind of kept prices stable. It stabilized the market. So like you said, you do have that, you know, you still have 2 offers or 3 competing offers, which is, you know, if you're a buyer, you know, that's one too many.
Yeah, that's one too many.
What do you tell people that are saying, well, I want to hold off? Obviously, the refi game, that's busted. We know that. But for new homes, what do you tell people that say, well, I'm going to hold off till rates go down to purchase?
Oh, man, I tell them, don't do that. Don't do that. I mean, you can do that if you want to compete. Like, if you enjoyed competing and you want to be overpriced and you want to waive everything, then you might want to wait. But honestly, no, because what's going to happen is that there's other people out there that are doing the same thing. They're like, oh, no, we're going to wait till rates go down. So as soon as rates do shift and go down, guess what? There's going to be all those people coming out, plus more, out of the woodwork, trying to buy, and then you are again in competition. Instead, if you are able to qualify right now and buy your home, and yes, the mortgage payment will be a little bit higher than what you want it to be, but it's still affordable to you, then why not lock in a home now, purchase now, and then when rates come back, you're in a position where you can just refinance. You don't have to compete against the rest of the market. You can just refinance and sit back and just watch and just be like, you know what? I'm thankful I did buy when I did, because I was able to get this or this type of deal, and I wasn't competing against 15, 20 people. Because what's going to happen is we're going to replay this video when that time comes, and we're going to remind the people, like, yeah, you didn't want to buy around the 7s, but when rates came down, then what's going to happen? You know, how many people are you going to compete against?
About $1,000 every time I say I told you so.
Yeah.
Yeah, I mean, but that makes sense, because I feel like you're not as, like you said, it's not competitive now, or it's not as competitive. So you can actually get properties for lower than asking now. You don't have to give up your contingencies, right? So you have more leverage for this is like one of the few times in my 20-year career that it's kind of a buyer's market.
Yeah.
And it's also the season too. Let's not forget that the market is back to seasonality, where in pandemic we didn't care about this. Seasons didn't matter. It was sweet all year round. It was spring season all year round, you know, for like 2 years straight. So now we're back to seasonality, where historically July, August are the slowest months. Everybody, you know, people move, people's behaviors are in patterns. And so, you know, the pattern is after Labor Day. Everybody comes back. They start shopping again. We have kind of the second spring market of October. But, you know, you have leverage right now, right? So if people wait, till spring, where we think that, you were saying earlier that you think, and other lenders have said that they believe that's when rates are going to start to come back down, is going to be competitive again. So you're going to be spending $100,000 over asking again.
Yeah.
$200,000 over asking, $50,000 over asking. So it balances that whole rate. That rate savings that you're getting is blown out, right? It equalizes. So it is better to get something now for the low and then refi, because the rates are going to come down much sooner than we think. I mean, what was the inflation report? What's inflation at now? Like,
history shows that, when inflation is what it is, this is what they do. They increase rates, and then when inflation comes down, rates come down.
So we're almost at the 2% target.
Yeah.
So I'm thinking, I've heard beginning of first quarter, 2024, right? Some people have said, end of last quarter. Yeah. So, but look what happened when rates dipped down a little bit. What was it, a few months ago?
Yeah.
The market picked up, right?
It did.
What was it? Was it like...
they were in the low sixes.
Yeah. They dipped down just a little bit.
Just a little bit.
Yeah. So, I'm in agreement there for sure. Buy now, leverage yourself. Refinance later.
Yep.
One, you're not...
Date the rate, marry the house.
I like that.
Yeah. Date the rate, marry the house.
Marry the house. I like that. I'm gonna use that.
Yes.
If that's all right.
Yeah, of course. Gotcha.
What do you think? What would you think the number one mistake that first-time buyers do when it comes to like house shopping or dealing with a lender?
Well, one of the mistakes that I think they don't know is how much their credit impacts their rate, and how much their spending can limit how much home they can purchase. Some people go out and buy that fancy car first, when that takes away from the income that can help them qualify for the more comfortable home that they really want. You know what I mean? So I think sometimes people just don't know how it affects them, their spendings, like their credit spending.
So you think so
for first-time home buyers?
So no big purchases before you start shopping for a house.
Yeah.
Or while you're shopping for a house, because that could kick you out of underwriting, right?
Yes. I can totally kill the deal.
Have you seen that before? Has that happened?
Yes. They're like, oh, I'm done. Everything's good to go. We got the house, and then they run their credit and they go and buy the car because they want the house and the car before closing. And then we get an alert. Yeah, because credit is monitored during the whole time, during the process when you're purchasing a home. So if you go and do a credit inquiry, then it tells us you've done a credit inquiry and you've acquired credit for this amount. And then the underwriter needs to see what the payment is, and then that can totally change your debt to income ratio and make it so that you don't get the house. Yeah.
What do you see most, an issue with your buyers when it comes to credit? Like what's the biggest?
Well, it's also what statistics was said when inflation happened and things got so expensive, people will be using their credit cards so much. What we're seeing now is that's what it is. People have been using their credit cards, they're maxed out. And unfortunately, they have multiple credit cards. So there are multiple payments that they're making every month. And then it takes away from their, ability to qualify for a higher mortgage payment.
So is it mainly debt to income?
Debt to income ratios, yeah.
As far as people, what about people? So some people have low credit scores because they have no credit.
Yeah.
What's a good way for those people? I feel like, in my opinion, that's probably the best bad credit to have is no credit.
No credit. Yep.
Because you can build that up, right?
Easily.
Relatively quickly.
Quickly as well.
What's the fastest and best way for people that don't have any credit to build up their credit to a point where they could buy a house, providing their debt to income and it's all good?
Well, one of the fastest things that they can do is open up a secured credit card. A secured credit card is something that one of their banks can offer, where they give a certain amount of money, like for example, $300 towards the secured credit card, and then the secured credit card, the bank gives it to you. You use it and then you pay it off. You use it and then you pay it off. And then after a certain period of time, whether it's 6 months or a year, based on that creditor, they'll give you just the credit card. And then that money will be put back into your account but then you've already built your credit. So it's kind of like telling, hey, Mr. Bank, I am a reliable person. I will pay my debts on time, but here's $300 so you can trust me with the secured credit card. And it's something that you build. There's other people that also get added on as authorized users on their relatives or parents. I know we've also seen memes where parents can start helping their kids.
Car note, right? Yeah. Mortgage too.
Mortgages too. They can be added into certain liabilities that have good credit rating. Of course, you want to make sure that they have a good payment history on that and they have a really low balance, and then you would be able to add that history to your credit history. And then it makes the credit score think that you've had it for that long.
Make sure whoever's adding you has good credit, right?
That part.
Nobody with bad credit is adding you.
No.
Like,
good payment history here. Yeah. That's it. Low balances.
So I would love, like, later on for you to come back and us talk about credit.
Oh yeah,
like,
we can go more in depth. Yeah.
And show people how to improve their credit, like closing revolving accounts that they're not using. I mean, just also because I think that's especially in lower income communities of color, that's a major issue. I was a loan officer, for a while. I started off with right out of college. I was a loan officer with Nations Bank before they became Bank of America. So I'm dating myself. But I remember, I remember working in the branch in Anacostia with right across from the big chair. Yeah. Then I moved to Forestville, and that was always the issue. That was the issue. One is either people just weren't educated, right? So they didn't know what to do. Yeah. So I want part of, I think, and I speak for myself, and I'm sure, just from knowing you, Romy and I have been friends for a while, so from knowing you, you probably feel the same way. But I feel like part of my job, I'm blessed to do what I do, but I feel like a great part of our job is educating people and making dreams come true for people and empowering people. Yeah. So I think that is an important element that I like to do, even if that person is not my client. Yeah. And that's why I'm doing these part of why I'm doing these videos. Obviously, I want people to get familiar with me, build my brand. But at the same time, I feel like if I could reach someone out there, someone that could buy, someone that could change it, because I remember myself not being, when I graduated college, I'm having fun, I'm in the streets. I didn't know that I could buy. Yeah. They had programs that I could have bought, and I'm mad that everybody has that real estate, like, I could have bought that house, I should have bought, It changes the trajectory of your life financially if you can buy, at the right time, at the right space.
If you know.
And I did not know for a while. I was like, because that was a no money down, no doc era.
Yeah.
Where if you had a certain credit score, you could walk in and you could buy a building, you could buy several. I did not, as long as with no money down, 100% financing,
back then,
and no docs. It was a no doc loans. You didn't have to show. You could have said, I make 200, 300, 400,000. Nobody asked you. Yeah. It was easier. I remember buying my first house in 2004, and I still had to have my mom co-sign for my car. Like, it was easier to buy a house and a car. Yeah. We're never going to see that again. I wish I'd bought like 20 houses.
I know.
I mean, that's partially why we got into that problem, because a lot of people who had no business buying
were bought.
But the people that I know that, like myself, that maintain their homes did very well and, leveraged very well. So, but damn, I wish I was educated maybe 3 years earlier. So here we are.
Trying to educate you guys. Yeah.
Educating you guys. And
you only have to be 18 to buy a house. Did you know that? You can be 18 and buy your house. You don't have to wait until you're 21. So you can honestly buy a house before you even start drinking legally. How cool is that?
Yeah, that's incredible. You could be sitting on that. By the time you get your first legal drink, you could be sitting on equity.
Hey, amen to that.
you could really
Somebody's going to hear us out there. Right. They're going to pay attention.
So what would you say? So we talked about rates earlier, right? Yeah. Obviously, the climate has changed, because of the fight to control inflation. And now rates are significantly higher than they were. Those 2% rates that you guys saw, that's probably not going to happen again. That's going to be like the no doc loan era. Yeah. But rates did hover around 3.5% to 4.5%, which is still, if you look at it, these are still like 40-year lows. Yeah. These are still like lows that people didn't have. I don't think rates were even like that in the 70s. Yeah. So it's still a great climate. But But for right now, for people that want to buy, I know we talked about buy down options.
Yes.
So people that just can't stomach that rate, they don't want to pay the 7%. What are the rates now?
So they're in the high sevens sometimes for the buy down options. Yeah.
Okay, so high sevens.
Yeah.
So for your primary residence, what's the rate right now for a 30-year jumbo?
So you're in the jumbo space, you're probably like in the 7.5, 7.25.
What about FHA?
FHAs, you're going to be in the high sixes.
Okay.
6.875. Depending on your credit, that's with a good credit score. If you have a lower credit score, you're going to be in the low sevens somewhere.
And banks are kind of frowning on jumbos now, right?
Yes, they are not finding enough investors, and they get a little bit more nervous when there's so much volatility in the markets, because at the end of the day, these are huge loans, you know, so you got to have enough investors investing to make sure that these are backed up and that they're going to be serviced. Yeah. Because no lender wants to be stuck servicing a loan, because then that takes away from the liquid to be able to continue to do other purchases and to function.
So the bank is, and that's interesting that you say that, because bank, you know, I tell buyers all the time that are freaking about the home values, that the bank actually has more skin in the game than you do.
Yeah,
right? You're putting down 10%, 5%, 20%, 3%. The bank is putting down most of that.
Yeah.
So when it comes to appraisals, the bank is like, you're never going to overpay for a property, right?
No.
The bank is not going to allow it.
No.
If you're paying cash, you can.
Yeah.
But the bank is not going to allow it, because the bank is not going to loan on something that's,
the value's not there.
The value's not there, so they're protecting themselves. So as a
and
default,
you at the same time,
well,
if
that's
you think
that's
about
a default, but primarily
primarily, of course,
but you're protected
because they're putting the bulk of the money out anyway.
Yeah, so I tell people, don't freak out about when you're, especially when you're in a multi offer situation and you escalate. And if you have your contingency in place, don't freak out about it.
Yeah.
Because what'll happen is you'll win the property. You know, it'll go to appraise. If it appraises, great. If it doesn't appraise, guess what? 9 out of 10 times they'll bring it down to what it is, and they'll work with you. They're not going to go to the other people unless the other people. I've seen, you know, situations where other people are cash. They're like, we don't care.
Yeah.
But usually they'll come back to you, and at least you're in control of that property, and then you have an opportunity to say, hey, I want to turn it down, or I want to move forward.
But at least you're in the game.
Exactly.
You're in communication. The communication keeps going.
Yeah.
And you're ahead of everybody else that made an offer. So if you really want the house, the opportunity's there. You know, you just got to negotiate and keep everybody talking.
Yeah.
That's really what it comes down to on that.
So back to the buy down. Tell us like what. You know, so we had a meeting earlier this year, on Tuesday, and we were talking about because prices are being reduced, you're seeing that across the board because, you know, like we said, it is kind of tilting towards a buyer's market for the first time ever or in a long time. And instead of reducing the prices, instead of reducing, you know, 100,000 reduction or 75, what we're seeing and what we're experimenting with is giving people an opportunity to buy down. So giving a credit. What's the max credit that somebody can get? What's the max seller credit that a buyer can get for a buy down? So
if a buyer is putting anywhere less than 10% down on a conventional loan, the maximum they can get is 3% from the seller.
Okay, so let's say it's a $700,000 house, and we're putting down $50,000, which is less than 10%.
Yeah. So then 3% would be $21,000 seller credit.
So the seller could give $21,000 to the buyer as a credit.
Yep.
So the seller will net $21,000 less of whatever the sales price is. And what kind of buy down does $21,000 get you?
So that $21,000 can be used towards closing costs. It can also be used towards buying down the rate, or it can be used specifically for what it's a buy down. So one of the popular buy downs we have right now, it's a 1-year buy down. And what that does is it lowers the rate by 1% for the whole year. So let's say if today's market rates are 7.5, you're buying down the rate to 6.5. So then your mortgage payment for a whole year is based on that 6.5 interest rate. And what is happening is that the lenders are holding this money that the seller's giving in an escrow to pay for the difference of the amount of what the mortgage payment would be. in hopes that, of course, when that year is over, we're all in a better position and are able to refinance into something hopefully lower than what that 1 year buy down is.
Okay.
Yeah.
You can do a 2-point buy down?
Yes, we can do
the
that.
max?
Yes, right now that's the max.
Okay. My favorites. What do you think about them? Can you kind of give us a quick summary on the process?
So 203K loans are loans that are used to renovate homes that are not in a habitable condition. So there's the 203K, which is a popular FHA 203K, but there's also conventional renovation loans. And they both pretty much work the same way, where you find a home that is considered perhaps not livable or habitable. It's more like, or maybe it's cosmetic, you know, you want to get some updates going on because it looks like the Brady Bunch was just living there.
And you don't have the money to
and
do
you don't
it.
have the money to do it, but you know that the neighborhood and the other homes in the nearby area have been updated and upgraded, so you know that there's more value to the home than what it currently sits at.
Okay.
So what you do is you go and you get contractors, licensed contractors that are insured.
ARV, after repair value, but go ahead.
You get those guys, they come in, they give you an estimate and tell you about how much those repairs are going to cost, what it's going to take, how long, and then you go and you provide that to the appraiser. The appraiser says, okay, with A, B, C, and D repair, this is going to make this property worth this much. So then we move forward to the underwriting piece, and then we underwrite them based on what the value will be. And then they, of course, have a down payment, whether it's 3.5% for the FHA 203Ks or 5% for the conventional renovation loans.
Why would people do a 203, a FHA versus the conventional or vice versa? Is it just the money down?
Well, yeah, it's just the money down, and it's also a credit score.
But is the rate better for the conventional?
It can be if your credit score is higher, yes.
Okay.
Because FHA has a fixed mortgage insurance, so if your credit score is below 680, 616, you get hit pretty hard in conventional.
Okay. And you can buy down any loan, right?
Yeah, you can buy down any loan.
So they give you up to what percent of the ARV after repair value of the home?
Well, it goes based on what your sales price is. So you get the property, the sales price, and then you get an estimated down payment amount.
Then they give you
the money to renovate it, and then they redo the numbers based on that value, and then they do that loan amount.
But don't they do it like I think it's 85% or 90% of the ARV that they'll loan you? They don't give you like all the way.
No, they won't give you all to the maximum amount.
Right.
But I don't remember that off the top of my head right now.
Okay.
But yeah.
I think it's like either 85 or 90, but you'll send us.
I'll make sure I do.
Send us
for
a list.
sure. I got you. Maya, you writing that down?
Well, this was awesome. Thank you so much for taking the time out to sit down and talk to me and educate our future clients, our current clients, and I hope we can do it again.
Oh, we will.
I think we have a lot to cover.
Yes.
You know, this industry is always evolving and changing, and I'm excited to keep evolving and changing with it.
I'm excited. Thank you so much for having me, Noel. And I look forward to hearing from all our prospective buyers or new referrals or anybody that needs any help and wants to get into the path of homeownership. We're here to help.